Are we at the brink of a new bull run in the stock market? Everyone is asking, is this the right time to invest or this is just a trap? Let me tell you this. The biggest wealth is created when you catch the bull run very early. You miss it and you could be the one left watching from the sidelines whilst the others makes the fortune. Throughout the Indian history, many brave emperors and kings fought valiantly to protect our motherland from external invaders like the Mughals or the British. However, they could not hold their fort for long despite their courage and strength. Why? Because there were enemies within, traitors who pulled them down from inside. We saw this with great warriors like Chhatrapati Shambhu Maharaj and Prithviraj Chauhan, where the internal enemies were the ones who pulled them down. Let me relate this to the Indian stock markets. We all enter into the markets with a great vision to create wealth. We are prepared with right arms and ammunitions, the knowledge, the savings and a long-term mindset. But just like those great kings, we face enemies within the market battlefield. Hi, this is Prabhanjan Rao from Elysian Investment Advisory. We are a SEBI registered investment advisory providing curated solutions for long-term wealth creation, financial planning, retirement planning and last but not the least, estate planning. So, stock market enthusiasts, hit the like and subscribe button and stay tuned till the last because we are going to discuss the current situation in the stock market, why our markets are falling, which is the most important thing as a stock market investor you need to consider and what strategies you need to employ and deploy to overcome the same. Our enemies in the stock market. Short-term volatility, that means the daily ups and downs in the stock market which shakes the investors' confidence. Global events. Political shifts like Trump's economic policies, wars or economic slowdowns across the world is also one of the reasons for the fluctuations in the stock market. Domestic events. RBI policy changes, sudden government decisions that creates uncertainties. Media noise. So friends, we all know that how media creates panic. They create exaggerated headlines, panic inducing headlines. So kindly stay away from these media hypes. And another biggest enemy which I foresee is our own emotions. Greed when the markets are rising and fear when they fall. Warren Buffett said, fear when the markets are rising. Be greedy when the markets are falling. But what are we doing? We are doing exactly the opposite of it. Why are markets falling down and should we be greedy at this point of time? Let's break all the reasons down. Short-term volatility and market valuations. Markets work on demand and supply in the short term. FIIs, DIIs, HNIs, insurance companies, domestic institutional investors, retail investors put their money where they find reasonable valuations. When Indian companies look expensive, they are compelled to look cheaper valuations outside India and thereby they make the investments outside. The second is currency depreciation. Nifty has given around a 12.5% return in INR terms, but in USD terms, the returns are much lower due to rupee depreciation. Time and price corrections. After a market rally, consolidation is very imminent and normal. Time correction means the market stays in a range-bound manner. Price correction means the prices fall. Profit booking. After a good historic run, institutional investors or any retail investors or any other investors for that matter, it is very normal in their ordinary course of business to book profits. US market impact. The US market is the mother of all markets, we cannot deny it. Trump's dollar strengthening policies and high interest rates led to fund infusions back to US. Tariffs and imported inflation. Trade tensions led to imported inflation in the US, forcing the Fed to maintain higher interest rates. FII selling. In the Indian markets, FIIs has been constantly selling their stakes in the last 3 years. So Why are they selling? They are selling it because they are getting a better returns in dollar terms in the US. So money from all the emerging economies are flowing back to US because they are getting a better interest rates in US and they do not have any currency depreciation issues. Drill, baby drill. This is a famous dialogue which Trump keeps on saying. This keeps oil prices range bound, impacting global markets. The China factor. Of late, the Chinese prices have corrected, which made its valuations very reasonable. So investors all across the globe are finding Chinese markets very well valued and reasonable. That's one of the reasons why the money from the Indian markets are flowing to other emerging markets like China. Corporate earnings lag. Indian companies' earnings are not keeping pace with expectations. Domestic consumption slowdown, rural distress and cautious spending hit consumption growth. What should investors do now? Overcome the fear of investing in falling markets. Accept that volatility is a part of investing. Market fall and rise, that is the nature of the game. Stay focused on the long-term goal. Historically, markets recover and reward patient investors. Educate yourself. Fear comes from the unknown. Knowledge eliminates fear. Second most important point is develop an appetite for short-term volatility. Volatility is your friend if you view it as an opportunity to enter into a quality stocks. Understand that corrections are very healthy and normal for markets if they remove the excesses. Train your mind to see dips as opportunities and not as threats. Another important thing which I have seen is most investors take the route of the mutual funds. Please mind you, mutual funds won't make you wealthy alone. Mutual funds are very good for averaging the returns, but real wealth is created with a carefully crafted portfolio which takes care into account your risk appetite and a goal-based approach is followed. Direct equity investing, if it is done right and carefully crafted, can create unique and significant wealth. Work with SEBI registered advisors. This is a paradigm shift which I would always urge to all the stock market enthusiasts and investors. Go with the advisors who are SEBI registered because they provide unbiased professional guidance. They help create a goal-based and risk-appropriate portfolio. Advisors also help with rebalancing, tax efficiency and understanding the market cycle. The do-it-yourself approach. To me personally, it is a trap. When the market is rising, everybody might be correct when they follow the do-it-yourself approach. But when the market corrects or during the market crash cycles, that would become a stock picker's market. So go with the SEBI registered advisors which will help you to create a long-term sustainable portfolios. Another important thing which I would always request and urge the stock market investors is to invest with proper knowledge, because investing without knowledge is like gambling. Timing the market correctly requires experience. Entry and exit strategies are very crucial. Market can drastically reduce returns. Focus on asset allocation. Diversify across equities, debts, gold and international markets. Adjust your allocation as per your age, goals, risk tolerance. Stay liquid all the time. Always keep some cash or liquid assets ready to take the advantage of market dips. Track fundamentals, not noise. Don't chase momentum stocks or follow herd behavior. Invest in companies with strong management, growth potentials and sound fundamentals. So viewers, a final thought. History teaches us that both in war and markets, internal weakness led to defeat. Don't let fear, greed or media noise become your enemies. Stay disciplined, seek expert advice, and you will emerge victorious in your wealth creation journey. Remember, be fearful when others are greedy and be greedy when others are fearful. Famous Warren Buffett Sahab. Have an Elysian day.